You know that specific smell inside a brand new car? That mix of leather, plastic, and glue? Marketing teams spend millions to engineer that scent. But do you know what a new car actually smells like the moment you drive it off the lot? It smells like burning money. It smells like your financial freedom flying out of the exhaust pipe. Most people see a new car as a symbol of success. Your neighbor bought the latest model, so he must be doing well, right? Wrong. As a financial mentor with 15 years of experience, I am going to tell you the truth that car commercials will never tell you. Buying a new car is likely the single worst financial decision the average person can make. Today, we are not just talking about cars. We are talking about how one emotional decision can cost you hundreds of thousands of dollars in lost wealth. I am going to show you the cold, hard math. I will show you what happens if you choose a different path. And I promise you this, by the end of this video, you will look at those shiny new cars on the highway, not with envy, but with sympathy. We are going to break down a strategy that will help you actually become rich in 2026, not just look rich. Why are we talking about this right now? Look at the economy. We are living in an era of high interest rates. The days of free money, when you could get a loan at 0 or 1%, are gone. Today, an auto loan can cost you 7, 8, or even 10% interest per year. Meanwhile, inflation is eating your purchasing power, and new car prices have hit historic highs. The average price of a new vehicle in America is now over $48,000. Think about that. $48,000 for a piece of metal that sits parked 95% of the time. People try to fill an internal void with external things, and dealerships love that. But right now, with economic uncertainty and the risk of recession still looming, locking yourself into a 5 or 7-year loan is financial suicide. The old method of living for today does not work anymore. If you want to survive and thrive, you need cold logic, not emotions. Let's break down the mechanics. Why do I call a new car a liability and not an asset? Assets put money in your pocket. Stocks, real estate, bonds. Liabilities take money out of your pocket. A car is the king of liabilities. In finance, there is a term called depreciation. It is the silent killer of your wealth. The second you sign the papers and your front tires cross the curb of the dealership, the magic is gone. You instantly lose 10 to 20% of the value. Imagine you bought a car for $50,000. You drive it 1 foot, and now it is worth $40,000. You just incinerated $10,000 in 60 seconds. You might have worked 3 or 4 months to earn that money, and it vanished into thin air. Over the first 5 years, a car loses about 60% of its value. That is a mathematical fact. It is like buying stock in a company while knowing the chart is guaranteed to crash. No sane investor would touch that deal. Yet, millions of people do it every day. Now, let's get into the meat of this. Let's look at the numbers. Let's take an average guy. Let's call him Mike. Mike makes a decent salary, but he wants to impress people. He buys a brand new SUV for $50,000. He does not have the cash, so he puts down $5,000 and finances the rest. The term is 5 years. The rate is 7%. His monthly payment is roughly $900. Mike thinks, well, $900 is okay. I can fit that in my budget. But that is the trap of poor thinking. Poor people think in monthly payments. Rich people think in total cost and opportunity cost. What is opportunity cost? It is what you could have done with that money if you did not give it to the bank. Let's calculate. Over 5 years, Mike will pay the bank much more than the sticker price due to interest, plus full coverage insurance, which is mandatory for financed cars, plus dealer service fees. But the scary part starts when we compare this to investing. Imagine an alternative scenario. Mike does not buy the new car. He buys a reliable used car that is 3 years old. This car has already taken the biggest hit in depreciation. The previous owner paid that stupidity tax for him. This used car costs, say, $25,000. It drives the same way. It has air conditioning and Bluetooth. It performs the same function, moving a human body from point A to point B. The difference in price is $25,000. Plus, every month, Mike saves on payments. Instead of giving $900 to the bank for rusting metal, he invests it. Let's look at the power of compound interest. If you invest $900 every month into the stock market, for example, in an S&P 500 index fund, which historically returns about 10% per year. Let's be conservative and use 8%. After 5 years, when Mike from the first scenario is left with an old car worth pennies, our smart investor has over $66,000 in his account. But wait, we do not stop at 5 years. Cars are bought for a few years, but wealth is built over decades. If you keep investing that $900, money you were used to paying for a car loan, for 20 years, hold on tight. After 20 years at 8% returns, you would have over $530,000. $500,000. $500,000. That is the true price of your desire to drive a new car. Are you really willing to trade your comfortable retirement, your children's education, or your financial freedom for the smell of new plastic? The math does not lie. Every $1,000 spent on a depreciating liability is murder to your future capital. Of course, I can hear your objections. You will say, but a used car breaks down. I will spend money on repairs. This is the classic argument people use to justify emotional spending. Let's be honest. Yes, used cars need repairs. But even a major repair, like a transmission or engine issue costing $2,000 or $3,000, happens rarely. And even if it does happen, it is still mathematically cheaper than losing $5,000 every single year just on depreciation, even if the new car never breaks. You pay for depreciation strictly and guaranteed. Repairs are just a probability. Paying a guaranteed $10,000 in losses to avoid a possible $2,000 repair bill is bad arithmetic. Plus, modern cars, especially Japanese brands, easily run for 200,000 miles without major issues. There are exceptions. I promise to be objective. When can you buy a new car? Case 1. If your net worth is over $1 million, if the price of the car is less than 5% of your total net worth, go ahead. You have earned the right. For you, it is a toy that will not damage your financial health. Case 2. You use the car for business and can write off the value against your taxes. In the United States, Section 179 of the tax code allows this, but for most employees, this does not apply. So, what is the action plan for 2026? First, shift your mindset. Stop trying to impress people who do not care about you. No one looks at you in traffic and thinks, wow, he is cool. They are looking at the car. Second, follow the rule of 1/10. The value of your vehicle should not exceed 10% of your annual income if you want total safety. Or, more realistically for starters, no more than 25%. Third, buy cars that are 3 or 4 years old. Let the first owner pay for the depreciation cliff. Fourth, pay cash. If you cannot write a check for the car, you cannot afford it. Period. Consumer debt is slavery. Let's summarize. Wealth is not determined by how much you spend. Wealth is determined by how much you keep and grow. A new car makes you poorer the moment you buy it. Investments make you richer while you sleep. The choice is yours. Look rich today or be rich tomorrow. It is boring discipline, I know. It is way more fun to rev the engine of a sports car. But the real thrill is opening your investment account and seeing a number with 6 zeros, a number that allows you to walk away from your job whenever you want. That is real freedom. That is real power. If this video made you think and maybe saved you from a $50,000 mistake, hit the like button and subscribe. Here, we talk about money without the rose-colored glasses. Let me know in the comments. What car do you drive right now, and do you regret buying it? I want to hear your stories. Remember, the best car is the one that is paid off and the one that drives you toward financial independence. I will see you in the next video.